Stop. Are you tired of feeling lost when people talk about the stock market? Do terms like dividends, ETFs, or capital gains make your head spin? Well, today is the day you finally understand it all. No jargon, no confusion, just simple steps to get started. Welcome back to Wealth for You, where we make money matters simple, fun, and stress-free. So grab your coffee, smash that like button, and let's turn you from confused to confident about the stock market. Let's dive in. Section 1. What is the stock market? Imagine the stock market as the world's biggest marketplace. But instead of fruits and veggies, people are buying and selling tiny pieces of companies called stocks. When you buy a stock, you're not just tapping a button on your phone. You're actually buying a small piece of ownership in a company like Apple, Tesla, or even your favorite coffee chain. Think of it like owning a slice of your favorite pizza. But here's the magic. This slice can grow bigger over time, even while you're just chilling and living your life. Pretty cool, right? Section 2. How do you make money? So how do you turn these slices into real money? There are two simple ways. 1. Price growth through capital gains. Imagine buying a stock at $100. Over time, the company grows, becomes more valuable, and now your stock is worth $150. If you decide to sell it, you make a neat $50 profit. Buy low, sell high. That's the name of the game. 2. Dividends as passive income. Some companies are so profitable, they share a portion of their earnings with you, just for owning their stock. This payout is called a dividend. Think of it like getting a bonus check in the mail, without having to lift a finger. It's like owning a rental property that pays you every month, but without the headaches of leaky faucets or dealing with tenants. Section 3. How to choose good stocks. Now, how do you pick a stock that could be your next big win? Here are 3 simple tips. 1. Check the company's growth. Is the company making more money each year? Look for consistent revenue growth and increasing profits. A company that grows steadily is often a sign of strong business fundamentals. 2. Love the product. Do people love their products or services? Are they part of your daily life or gaining popularity? If you or your friends can't stop using it, chances are others can't either. That's a strong indicator. 3. Strong leadership. Behind every great company is a great leader. Look for companies with visionary leaders who have a track record of making smart decisions and driving growth. Leadership can make or break a company's future. And hey, you don't need a finance degree to spot great companies. Just look around. What brands do you trust? What apps do you use daily? If it's something you believe in and can't live without, that might be your first clue to a winning stock. Section 4. How to choose dividend stocks. Looking to earn passive income? Here's how to pick great dividend stocks that can help you build wealth over time. First, focus on stable, reliable companies. Think of businesses with a strong track record of paying dividends consistently. Companies in utilities, consumer goods, or big-name blue-chip stocks that have been around for decades are great examples. Stability is key. Next, aim for the dividend yield sweet spot, which is between 2 and 6%. If it's too high, it could be risky and sometimes a sign of trouble. If it's too low, it might not be worth your investment. Find that healthy middle ground. Then, check the payout ratio. This ratio shows how much of the company's profits are paid out as dividends. A healthy payout ratio is usually under 60%, meaning the company keeps enough profits to grow while still rewarding shareholders. Also, look for dividend growth history. Search for companies that increase their dividends year after year. This is a sign that the company's profits are growing, and they're confident about the future. Think of dividend stocks like planting trees. The longer you hold them, the more shade, or money, they provide over time. Patience really pays off. Section 5. what are ETFs and how to choose good dividend ETFs. Now, let's talk about ETFs. Exchange-traded funds. Think of an ETF like a basket of stocks. Instead of buying just one company, you're buying a collection of them, which helps spread out your risk. When it comes to dividend ETFs, here's what to look for. First, check for high-quality holdings. You want strong, stable companies that regularly pay dividends. Next, look at the dividend yield. Just like individual stocks, aim for a balanced yield. Not too high, not too low. Also, consider the fees, specifically the expense ratio. ETFs charge small fees to manage your money. Look for ETFs with low expense ratios, ideally under 0.5%. Lastly, some ETFs focus on companies that grow their dividends over time. This means your income can increase year after year. If picking individual stocks feels overwhelming, dividend ETFs are a fantastic way to invest passively and still enjoy steady income. Section 6. Quick recap. Let's wrap it up with some quick takeaways. First, the stock market is like a marketplace where people buy and sell pieces of companies. Second, you make money when stock prices rise or through dividends. Third, do your research. Look for companies that are growing, have popular products, and strong leadership. Fourth, for dividend stocks, focus on stable companies with healthy payout ratios and growing dividends. Fifth, dividend ETFs are great for passive investors who want steady income without picking individual stocks. Remember, investing isn't about getting rich overnight. It's about growing your wealth steadily over time. Conclusion. If you found this helpful, smash that like button and subscribe to Wealth for You for more simple, no-nonsense money tips. Got questions? Drop them in the comments below. I love hearing from you and helping you on your investing journey. Remember, you don't need to be rich to start, but you need to start to grow rich. The best time to start was yesterday. The next best time is right now. Thanks for watching, happy investing, and I'll see you in the next video.